Guys, I think that everybody goes about this business wrong, especially if you're someone that doesn't have as much capital as you would like, someone who wants to grow fairly quickly. You don't have capital at your disposal, but you want to have all the benefits of trading and all these sorts of things. I still think that most people are focusing on this the completely wrong way. And so I'm going to share with you what I think would be the best way, if I could go back in time, how I would approach this industry. Now, the first thing to understand this is we need to kind of take a look at prop firms because this is what most people will look at. In fact, one of the most common questions I get nowadays is what's the fastest way to get funded? Okay. Arguably one of the worst questions in the trading space, not because it is, ill-intentioned, but because it contributes to absolutely appalling behaviors. Specifically, what's the fastest way to get funded? Well, let's look at how prop firms started, right? Most prop firms started with something like a 10% target within a specific time period. So this started off as traditionally about 30 days. And it was like this for many, many years. It wasn't until recently that it was changed to basically having an unlimited amount of time for the challenge, which was a big, and to be fair, a very, very good change for the prop industry. However, the scars and the wounds left from the long period of time where this was the case are still there. Because when you go to a beginner and you say that there is a capability for you to make a certain amount of money within a certain amount of time or a certain percentage within a certain amount of time, beginners are people who want to believe all of the good sides of trading. They haven't actually seen the good results themselves yet, but they have to rely on belief. And because they're relying on belief, they're going to be subject to a lot of the mental biases that we all have as human beings. The big one in this case is going to be confirmation bias. This is the idea that as soon as you have something that you want to be true, you're going to look for evidence that confirms your belief. Now, this is very, very dangerous because obviously a lot of the things that we want to be true about trading and about life just aren't true. And so if we're finding evidence to back up what we think is true and ignoring reality, then all we're really doing is dooming ourselves into really, really poor progress consistently over time. And that's not what we want whatsoever. So, what does this mean? Well, it means that even though this has been reduced to extended to unlimited time period to make this now, we need to start reevaluating how we actually look at trading performance because it's very, very easy to look at all of the people online telling you that every single month should be up and everything is going to be really rosy the whole time, but that's just not the reality. Now, I'll give you an example. I've had many, many times where throughout the course of a year, not every single month is profitable. In fact, I don't think I've ever had a whole year where I've had every single month being profitable. It's just not happened for me. Now, yes, you could argue that, there's other things I could have done and diversified my strategies or timeframes or assets or blah, 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 blah. But at the end of the day, you can't run away from drawdown as a trader. In fact, if you run away from it, which is what a lot of people try and do, the closer to it you will often get because you are so focused on minimizing the drawdown, you actually tend to reduce your ability to maximize the upside, which is a lot of what trading is about. It's maximizing those opportunities where you're right rather than trying to avoid the times where you're wrong, because that's just pain avoidance rather than anything else. Um, And so I'll give you an example, right? 12 months out of the year, nine of those 12 months were profitable, and three, obviously, out of 12 were negative. So let's look at this as if we were going for prop firm challenges. Let's just say that we started on month one, and month one came out as negative, right? Now, these negative months, due to good risk management practices, weren't that negative, but that's not the point. 30 days pass. We're in a worse spot than when we started. Well, that's not great, is it? Well, what happens next? Well, let's just say we move into the next month. Let's say we're really unlucky and we have another negative month. Okay, mine didn't tend to be on consecutive months, but let's just be go follow the worst case scenario. Then we go another 30 days, right? At this point, we've had 2 months on the trot of negative results. Then on that next month, then we have a big month. We passed the challenge. Maybe we even passed the challenge and the evaluation on the in 1 month. This often happens, and of course, it depends on the type of system you have and things like this. This particular system was with a system that maximized the upside, so it had a kind of slightly higher risk reward type system, and therefore, the fluctuations of results did vary a little bit. I tried to offset it with having multiple strategies and specifically multiple pairs and uncorrelated things and stuff like this, but for the most part. That was how it worked. And so what happened is then on that third month, what would have happened is more than likely you would have been able to pass both stages in 1 month. But the problem is most people won't sit through this. Most people don't want to do this. Most people think that they're better than that. And my question to you is if you think that you are in that, by the way, I used to think I was better than it as well. I was like, oh, no, I won't run into that problem. If I just keep working, I'm just going to have this perfect system. Just look at your own training journey. Or if you still don't believe me, tell you what, just remember this video and come back in 6 months and tell me if your hypothesis was right or wrong. Because I guarantee you that for the vast, vast, vast majority of you that aren't at that stage yet where you can really begin diversifying and reducing the risk in many, many ways, if you're going for these bigger target months, you are going to have drawdown months. It happens. Now, depending on the frequency of trading, maybe it's not drawdown months, maybe it's drawdown weeks. There's lots of different variations and workarounds, but I'm giving you a worst case scenario to show you that the actual reality of trading isn't always so easy. And so, what is the solution? How would I go about this if I could go back? Well, it's easier to get more capital than get more percentage. This is a huge, huge thing that I think people misinterpret. Now, getting more capital in terms of a prop firm is probably the easiest bet for a lot of people out there to get a lot of capital, but this does come at the cost of being a little bit more patient. But the thing is that if you think in longer time horizons, you will typically make more money, right? People who are thinking, what can I make today, are typically not going to have the same amount of foresight that is necessary for long-term success as someone who's looking out months, several months, years into the future, right? Because if you look at a lot of professional traders, they're not risking 1% per trade. Okay, if you've got billions under management or yards, as they're known in the financial industry, as in 1 yard is 1 billion, right? Then you're not going to be risking 1% per trade. It's just not going to happen, right? That would be really, it's just not as necessary. But of course, this isn't very applicable to the everyday person because most of us don't have billions at our disposal, right? And so I understand. So that'd be option one. The other option is you get some kind of a qualification where you are able to manage other people's money. There are certifications that you can get to actually do that, which opens up a lot of doors for you because then you're essentially running a kind of version of a hedge fund, which is the route that some of you may want to take. The good thing about that route is that even though there is a lot of more legislation and things like this, you don't need to earn anywhere near the percentages that prop firms are telling you to get. So instead of like 10% a year, 10% would be a good benchmark for the whole year instead of per month. So instead, if you manage to just get 20% per year, you will have no shortage of clients begging you for money. But what most people do is they're so obsessed with the short term. I need to pass prop firm challenge. I need to pass prop firm challenge that they completely lose sight of this. But what they should really be doing is building a track record over the long run. And even if you're making 2% a month, 2%, that is going to be considered very, very good. Focusing on having a smooth equity curve, that's going to be another thing that makes your strategy and your process a lot more appealing to people. But if you keep going down, prop firm fail, pass, oh my God, I got some money and maybe I got a payout and then I fail and go round, you're thinking too short term, right? It's no different to having a job. Now, this is not me criticizing jobs whatsoever. It's one of my pet peeves when I see any guru online saying, "Oh, people who have 9 to 5s are idiots." Like they're complete morons. If anyone ever says that to me, I just literally just blank them and walk away. Why? Because that is the backbone of the economy and how the world operates. And those people are just entitled little pricks. Anyway, a little bit of a rant there, but it does annoy me. Um, so transitioning into how this is applicable, because most of us get into trading to actually go ahead and make money, which I completely understand. The next kind of layer down is looking at basically improving your risk adjusted returns. Now, I've spoken about this in a few videos recently, so I'll just draw out a little chart for you as an example. So if we have a chart here, if one system makes more money over the long run, let's just say, but the balance of the account looks like this, This is going to be less attractive, even though let's just say through this whole period we make 300%. In fact, let me just get rid of some of this over here. Okay. So let's just say this strategy here, we've made 300% over the course of, I don't know, a year, right? So a very high performing strategy, very, very nice indeed. Now we compare that to a second strategy that makes much less. Maybe we come out at about, I don't know, 40% in a year. Which one of these strategies is going to be more valuable? Well, in my opinion, it's going to be this one right here. Why? Is it just because it made less and is therefore safer? No, it's because of the smoothness of the equity curve, right? This curve is a massive indicator as to the amount of risk that your strategy actually entails, right? So the reason for this is because if we just risked more with this system, we would make more. But the difference is that because we don't have these massive swings, we're going to be much more likely to have consistent results over time. This makes it quicker for you to iterate. So what does this mean? Well, let's just say you run into a problem with a trading system. Okay, most people completely screw this process up to begin with, but let's just say you run into a problem with your trading system. Here's what most people will do. They'll run into a problem and they'll panic or they will not be able to cope with it. And so they'll circle back and they'll start watching YouTube content, maybe new strategy videos, maybe new things that they can add to their plan, blah de blah de blah, and they'll circle back around here. But this, as you can see, is a cycle that always ends in the same place. The gutter, going round in circles. This is not how you improve. Instead, when we have a problem, what we want to be doing is we want to be moving through that problem, sticking with what we're doing, and we want to be able to take the data. So we need to be tracking everything, and I'll represent that with a little drawing here. So this is the data, and then based on that data, we will experiment with new solutions. Okay, we'll then review how those experiments works. We'll circle back here, and we'll keep doing this until eventually we can break off and the experiment leads to a result. Okay, so just to kind of simplify this, because I know there's little lines, when we face a problem, we look at the data to make sure that number one, it's a real problem, and then number two, what might be some solutions that we could fix it with. We then experiment with one of those solutions, see if it works by reviewing the data with the same criteria. Do we have enough data to make sure this is a problem? Have we validated that it's made any sort of significant difference, etc. Until we have found an experiment that works. And when we do, we then consider that a result. And then once we've got that result, we can move on to another problem. So we've got a result. Now we can move on to whatever that next trading problem is. This is what real trading is. Now, why is this related to what I was talking about down here? Because when your risk adjusted returns are better, because your results are more consistent, it means you actually need less data before making a decision about whether to use something or not. What does this mean? Well, if you've got a win rate, let's just say of, I don't know, let's just say you've got a win rate of 20%, your exposure to randomness in the short term is extremely high, meaning your months are much more likely to look like your equity curve, in other words, it's much more likely to look like this first line because your exposure to randomness is more. You don't know, when that big month is going to come, and it comes when it does come, it tends to cluster, and the rest of the time it feels a little bit random. And so, because of that, you need more data to establish whether this works. Now, an even simpler way of looking at this is if we imagine that we just had 10 trades and we want to see if we've made a mistake or not, and we've got a 20% win rate. Let's just say that those 10 trades come out as 10 losses. Do we know whether that system is ready to be changed or not with a 20% win rate? No. Why? Because the probability of us seeing 10 losses in a row with a 20% win rate is extremely high. We would need to see a much larger amount of losses in a row, or just in general over a particular sample size before we concluded that anything was right or wrong. Therefore, it's bad. However, if we compare this to, let's just say you had an 80% win rate, and by the way, when I say win rate here, it doesn't just have to be one dimensional. It doesn't have to be, oh, I win more trades than I lose. There are other ways to achieve risk adjusted return improvement, diversification being number one, strategy diversification, time frame diversification, asset diversification. I've got a whole video on that. I'll try and remember to leave the link there, but if I do forget, drop it in the comments below, asking for it, and I'll send you the link. But with this, if we have the same scenario, right, we have 10 trades and we have 10 losses, not 110, 10 losses, do we have more information here to change it? Yes. Why? Because with an 80% win rate, we shouldn't be getting 10 losses in a row. The probability of that happening is extremely low if that win rate is supposed to be held up. Okay, and again, it doesn't have to be direct win rate, it can be the win rate of a portfolio rather than the win rate of a specific strategy, which is a big mistake I think everybody misses because everyone's so obsessed with win rate in the beginning, forgetting that it doesn't mean you have to become some sort of wizard with a million data points tracked on one particular system in order to do well. It's something that happens gradually over time and you improve with as time goes on, and you can stretch that risk out over a portfolio. But anyway, this means why is this helpful? Well, because our exposure to randomness is less, which in plain English means that when we face a problem, we need less data, which means we can experiment faster, which means we get results faster, which means we can solve more problems faster, which means everything else just runs a lot faster. And so if you're really trying to improve, this is really what you should be doing, in my opinion. This is not financial advice. This is just my opinion about how to actually be an efficient human being in the context of trading, right? And then once we've got this, once we are improving at a good enough speed, then we can begin the cycles of, okay, how do we begin acquiring more capital? How do we stretch our strategy's performance? Is there a way to improve it in other ways? These are the things that are very, very important in trading that aren't talked about all that much. But I'll make more videos on maybe some of those more advanced topics for now. But honestly, the main message of this is that if you are trying to improve, the best way is the slow way. Build a portfolio. Okay, don't feel like your results are subpar just because you're not beating a made up number that someone has created on a prop firm challenge, which, by the way, is set up largely for you not to fail, but set up in a way that enough people will fail that it allows them to stay in business. Remember the game that you are playing here. Do not have rose tinted glasses when looking at the world. You have to be skeptical and look at things strategically. Those are the most important things, in my opinion. Now, guys, I've been having some ideas about the channel recently. Okay, this is just a kind of sign off point. I'm debating whether to start interviewing other traders, or something maybe like that. I'd be interested if you guys would find that interesting or not. Maybe doing some more lives, maybe hosting, I don't know, some webinars for you, which is kind of covering topics in more depth, or anything of the sort. I don't really know what you guys would like. Would you guys like an email newsletter where I'm going deeper into topics and, writing about specific, current updates or fundamental stuff or technical things I'm looking at? Or what sort of things would you guys want? Because at the end of the day, guys, I don't know what you guys want, and I would love to know so that I can actually help more of you to see the stuff that you're looking for. So please do let me know in the comment section below. I'll also put a poll up on the community tab probably later today. But yeah, guys, I hope you've enjoyed this one. I know it's been a bit of a rant. And yeah, hope you have an amazing rest of your day, and I'll see you soon. Take care.